Welcome to Talk Tickers. If you are looking at your portfolio right now, or maybe prepping for your next investment committee meeting, and you're just trying to make sense of the absolute whiplash in the AI infrastructure market, you are in exactly the right place.
Yeah, whiplash is definitely the right word for it this week.
It really is. Our mission today is to do a deep dive into the source material. We take the dense earnings transcripts, the management commentary, all that market data, and we extract the actual signal from the noise for you.
Because there is a lot of noise right now.
Exactly. And today we are building a comprehensive thesis around one of the most baffling market reactions we've seen all year.
Baffling is, it's an understatement.
Right. So let's set the stage. We're looking back at late February 2026. A high-flying AI data infrastructure company just posted their Q4 and full year 2025 earnings. And on paper, it looks like flawless execution. Massive top and bottom line beat. They raised their 2026 revenue guidance to 35% plus growth. They announced deep integrations with Palantir and the Mag 7.
And beyond the raw numbers, which we'll get into, they are quite literally building the cognitive scaffolding for the next generation of AI. We're talking the transition from simple chatbots to autonomous agents and physical robotics.
Which is why the market reaction makes zero sense on the surface. Despite this supposedly perfect fundamental momentum, the market immediately punished the stock.
Brutally punished it.
The next day, it was sent down over 7%. And it wasn't just retail investors taking profit. This happened on volume that was nearly 2.5 times the daily average.
Yeah, the institutional desks were actively hitting the bid. They were dumping it.
So our mission for this deep dive is to unpack this severe disconnect. We're going to dissect the financials piece by piece, look at the shifting unit economics of AI data engineering, and really dig into the highly technical product pipeline that management thinks will make them an indispensable AI lifecycle partner.
Because right now, the street is clearly assigning a massive execution risk premium to this company's transition. They do not trust the narrative.
Right. So to understand why the algorithmic models and the institutional investors are pricing in that risk, we first need to establish the baseline. We need the raw results from the Q4 2025 report.
Let's do it. So ending December 31st, 2025, let's start with the top line. Q4 revenue came in at $72.4 million. That is a 22% year-over-year organic growth rate.
Which is huge.
It is. And it handily beat the consensus estimates, which were sitting at $69 million.
And if we zoom out to the full fiscal year of 2025, revenue hit $251.7 million. That's a 48% year-over-year increase.
But anyone can buy revenue in software.
Exactly. You can always buy top-line growth by burning cash and handing out aggressive discounts. So the real question you have to ask when you see a 48% growth rate is, are they actually making money, or are they setting venture capital on fire to look good for the street?
That is the critical distinction. And in this case, the profitability metrics are actually what makes the sell-off so perplexing. Q4 GAAP diluted earnings per share came in at 25 cents. That translates to a net income of $8.8 million.
Let's pause and define that for you listening, because companies love to hide behind complex accounting. GAAP stands for Generally Accepted Accounting Principles. It's the strict rule book. A lot of tech companies emphasize their non-GAAP numbers, which conveniently strip out things like massive stock-based compensation.
Yeah, they're essentially saying, look how profitable we are if you ignore the millions in stock we printed to pay our engineers.
Right. But here's the fascinating part about this specific quarter. The adjusted non-GAAP EPS also came in at exactly 25 cents. They matched.
They perfectly matched, which means they are generating real clean profit. They aren't relying on accounting gymnastics to show a positive bottom line.
And that 25 cents was a massive beat against the 21-cent consensus estimate. We're talking a 19% bottom line beat.
And moving down the income statement to margins and EBITDA, the adjusted gross margin hit 42%. That safely cleared their own internal 40% target.
Okay.
Adjusted EBITDA was $15.7 million for the quarter. That's 22% of revenue. And it hit $57.9 million for the full fiscal year.
So they beat revenue, they beat clean profitability, they cleared margin targets. What about the balance sheet? Because right now, in early 2026, the cost of capital is a real headwind. Liquidity is your ultimate defensive weapon.
Pristine. Their balance sheet is pristine. Cash and short-term investments swelled to $82.2 million. That's up $8.4 million sequentially from the previous quarter.
Wow.
And up from $46.9 million at the end of 2024. Plus, they have zero drawn on a $30 million credit facility.
So they are entirely self-funding this hyper growth. They've got an $82 million cash cushion, untouched credit. By every traditional metric, this is a blowout quarter.
It is a total blowout.
But we have to pivot to the tape. This is where the tone of our deep dive really has to shift. Because the stock closed at $47.58 going into the after-hours call. But when the dust settled on the next day's close,
It plummeted.
plummeted to $44.17, a drop of over 7% on 2.7 million shares traded.
Against an average daily volume of just over 1 million. The street wasn't passively letting it drift. They were aggressively dumping.
Which means we need to be skeptical. We have to figure out what spooked the institutional desks. When a company posts a beat like this and gets taken to the woodshed, there's a hidden landmine in the forward guidance.
Always.
And the tension clearly lies in the transition costs and a very specific near-term margin squeeze.
The margin squeeze is absolutely the smoking gun. Let's look at the 2026 guidance. Management provided a top-line outlook of roughly 35% plus revenue growth for the year.
Now, they frame this as conservative, right?
Highly conservative.
Mhm.
They explicitly stated this projection is built entirely on active programs, recent wins, and late-stage evaluations where they have clear line of sight.
They're saying this is the floor, not the ceiling.
Exactly. Because LLM initiatives from enterprise clients can spin up incredibly fast. So the top-line guidance wasn't the issue.
Right, 35% growth is fantastic.
Yeah.
So the catalyst for the sell-off was the margin outlook.
Yeah. Management guided that early 2026 adjusted gross margins are going to temporarily compress, dropping from that triumphant 42% we just saw down to a range of 35 to 40%.
A drop from 42 to 35% is a massive red flag for algorithmic trading models.
It triggers automatic sell orders. The algos just see compression and dump.
But from a human analysis perspective, why are margins dropping if revenue is growing 35%?
It's the cost of landing and expanding. They are consciously choosing to carry excess capacity ahead of revenue ramps. They're aggressively front-loading investments into COGS and SG&A.
Let's translate those buckets for a second. COGS, cost of goods sold. In the AI data world, that used to mean paying gig workers pennies to draw boxes around stop signs.
Not anymore.
No. Today, COGS means hiring elite, PhD-level data scientists and advanced engineers to evaluate complex AI reasoning. And SG&A means hiring highly compensated account leadership who can actually sell to a Fortune 500 CISO.
That transition is exactly what's causing the margin compression. They are pre-building the factory before the massive enterprise orders clear accounting.
But they expect these margins to normalize, right? Back toward 40% later in the year.
They do. The thesis is that as these new workflows scale up, they introduce automation and synthetic data generation, creating structural operating leverage. The human-in-the-loop costs decrease.
But the public markets are brutally impatient with margin degradation. When management says, our margins will compress now, but trust us, they'll expand later, the market immediately prices in execution risk.
The street is effectively saying, we will pay for the 40% margin when we see it on the income statement and not a second before.
And that skepticism is compounded by a pivotal operational data point buried in the commentary. We need to talk about the workflow transition at their absolute largest customer.
This is the data point that truly terrified momentum investors. It's a high-wire act without a net.
Break down the mechanics for us.
Management disclosed that in Q1 2026, they actively deprecated roughly $20 million of annualized post-training workflow revenue run rate.
Let that sink in for a second. They voluntarily allowed $20 million of revenue from their biggest client to just churn out.
In a quarter where margins are already shrinking.
It looks reckless on the surface. What exactly were those legacy workflows?
They were the commoditized, highly labor-intensive data labeling tasks, the early days of AI training, manual tagging of text or images. It's a race to the bottom on pricing because overseas competitors will always undercut your labor costs.
So they are intentionally bleeding out the cheap, low-margin work. But what's the replacement strategy? If you blow a $20 million hole in your revenue, you need a plug.
They immediately replaced it with a combination of new, highly complex post-training workflows and scaled pre-training programs. The net run rate effect was actually positive.
So this is the painful playbook of a company trying to evolve its moat. Accept the churn of replicable workflows and move up the stack into high-value data engineering. They want to be the architects, not the bricklayers.
Exactly. And embedded in that 2026 outlook is customer diversification. They expect the rest of their customer base to grow significantly faster than this anchor customer.
They're targeting the Mag 7 AI labs, sovereign AI initiatives, Fortune 500s.
Right. But a risk-averse portfolio manager looks at that $20 million churn and sees extreme volatility. They see a revenue base that needs constant replacement just to stay flat.
If they stumble on just one enterprise contract, the whole 35% growth narrative falls apart.
Management is pushing back hard on that bear narrative, though. They called this a golden age of innovation on the call. They're trying to shift the client conversation from how much data do you have to how effective is your data.
To understand that shift, we have to examine the three strategic pillars of innovation they outlined. This is where the deep technical mechanics come into play. Pillar 1, generative AI model training and long context reasoning.
Historically, a client gave them a rigid order. We need 1 million annotated images of cars. You fulfill it, hand over the hard drive, and you're done.
The methodology has completely evolved now.
It has. The company is actively diagnosing model performance gaps using custom evaluation frameworks.
They're operating like elite AI doctors, diagnosing the specific weakness in a neural network, engineering targeted data sets to fix those gaps, and then running clinical trials.
Yes. They fine-tune the client's actual model or structurally similar proxy model to mathematically prove the data's efficacy before scaling production.
And a massive focus here is on long context reasoning. Let's unpack the context window for you listening because it is the biggest bottleneck in AI right now.
It's the AI's short-term memory.
Exactly. It's a model's ability to absorb, retain, and logically reason over massive amounts of information simultaneously. Imagine feeding an AI the entire 500-page Enron email corpus and asking it to connect a vague thread on page 12 to a specific transaction on page 480.
The classic needle in a haystack problem. And it's incredibly difficult without the AI hallucinating or forgetting info in the middle of the document, the lost in the middle effect.
And management noted that solving this can't be done just by throwing NVIDIA compute at it. It requires highly specific, structured training data created at massive scale.
And they claim they are making material progress there that competitors simply can't match.
Which brings us to Pillar 2. This is where the commercial applications become highly lucrative. Agentic AI and the chaos of the real world.
The core problem the enterprise software industry faces right now is that autonomous agents perform beautifully in a lab.
They book flights, scrape websites, summarize reports flawlessly in demo videos.
But the moment you deploy that agent into real-world production, performance degrades rapidly.
Because the real world is messy. Edge cases, unpredictable human behavior, adversarial conditions.
So this company built 3 hybrid solutions to combat that degradation. The first is an agent evaluation and observability platform.
How does that work in practice?
During development, data scientists use it to visualize and annotate agent trace data. They map out every decision the AI makes. They build LLM as a judge, evaluators, where a larger AI mathematically grades a smaller AI, and they generate golden data sets.
But it doesn't stop after deployment.
No. Post-deployment, it continuously monitors the agent. When it makes a mistake, the platform performs real-time root cause analysis.
And the financial catalyst here is massive. They are kicking off a managed services engagement with a leading hyperscaler, think Microsoft, Amazon, Google, to use this platform to improve a flagship virtual assistant.
That third-party validation is huge. If a hyperscaler trusts you to fix their virtual assistant, you are critical infrastructure.
The second solution under this pillar really caught my eye, though. Their managed agent optimization pipeline.
This trains agents using targeted reinforcement learning datasets specifically designed for real-world chaos. And they have hard data, up to a 25-point improvement in constraint satisfaction.
And in the most demanding scenarios, that performance gap between standard open source approaches and their specialized pipeline widens to 31 points.
A 31-point improvement is an absolute paradigm shift in machine learning.
But let's temper that with some corporate skepticism. A 31-point lab improvement is great, but does it translate to enterprise trust? If a bank's AI agent hallucinates and zeroes out a client's account, the legal liability wipes out any margin gains from automation.
That liability fear leads directly to the third solution, which might be the most critical for enterprise adoption, their adversarial simulation system, red teaming.
Red teaming is fascinating. Paying hackers to attack your systems to find vulnerabilities? But for LLMs, it requires a completely different approach.
It generates highly targeted, infinitely scalable adversarial attacks. We aren't talking about asking an AI to tell a dangerous joke. We're talking direct jailbreaks or indirect prompt injections via RA pipelines.
Let's translate RA pipelines. Retrieval augmented generation. It's when an AI searches a private internal database for an answer to ground it in truth.
Right.
So an indirect prompt injection means planting a hidden malicious command inside a mundane document like a fake resume, uploading it to the database and waiting for the AI to read it and get hijacked.
Exactly. They also test against multi-turn social engineering attacks, building trust with the AI over dozens of prompts. And they even test against steganographic payloads.
Steganographic payloads. That sounds like a spy novel. Explain the mechanics.
Steganography is concealing a file or message within another file. An attacker might embed a microscopic one-pixel alteration in an image of a lunch receipt. To a human auditor, it's a normal receipt. But the AI vision model scans it, and that pixel pattern translates to a malicious command like authorize full refund.
That is terrifying for a compliance officer.
It is. And the advantage of their adversarial simulation system is that it forces the models to generalize defensive capabilities, not just memorize defenses against simplistic tools. It teaches the AI to understand the semantic logic of an attack.
And the market signal is flashing green. They're gaining massive traction with CISOs and government security experts, positioning them as leaders in prompt layer security and AI trust and safety.
A highly defensible, high-margin niche. But to see where they are heading long-term, we need to look at Pillar 3, physical AI and robotics.
Management cited 2026 as the acceleration year for physical AI, intelligent systems physically perceiving and navigating the real world.
You can't just feed a robot Wikipedia and expect it to fold laundry. You need entirely different data types.
They highlighted two specific types. First, egocentric data.
This captures the world strictly from the robot's point of view in active motion. Not a static security camera. It's the shaking, dynamically changing feed of a machine moving through space, dealing with glare and shadows.
And the second type is affordance data. I found this brilliant.
It's not just teaching the AI to label a coffee cup. Affordance data teaches the system what physical actions are possible with that object, how it can be safely held if it contains hot liquid, how fragile it is.
Imagine applying that to an industrial valve in a manufacturing plant. The robot needs to know how much torque to apply before the valve strips. This deep understanding feeds directly into world models.
World models are internal, physics-based simulations running inside the AI's mind, allowing it to anticipate outcomes and plan physical steps ahead. You can't build them without massive amounts of egocentric and affordance data.
And they have concrete catalysts here. A significant engagement to create foundational robotic data sets, partnering with a leading robotics lab, and utilizing the system in high-visibility Palantir engagements.
But the number that jumped off the page was their computer vision work. They developed an AI model for drone and small object detection that exceeded state-of-the-art benchmarks by 6.45%.
To contextualize that, researchers fight for months for a 0.2% improvement. A 6.45% leap is unheard of.
It's a material leap, especially in harsh environments with cluttered backgrounds and intense noise.
And it has massive dual-use implications. Both commercial logistics and the global defense sector are going to come knocking.
Definitely.
So we have this incredible technological deep dive pushing the boundaries of generative, agentic, and physical AI. But we have to bring it back to the stock ticker. How does this sit in the broader macroeconomic context?
As of early March 2026, the broader software space is struggling. Look at the IGV software ETF. It's down roughly 18% over the last 30 days, down 12% trailing 12 months.
Meanwhile, the S&P 500, the SPY, is up almost 18% TTM.
A massive divergence. Software is in a bear market while broader indices hold up.
The market is bifurcating. AI infrastructure providers, chips, data centers are booming, but application layer SaaS companies are getting crushed because their moats are vanishing.
And this stock was already under pressure, down 26% over the prior 3 months, trading with high volatility heading into the print.
The street actually framed the quarter positively at first. Media called it an operational beat. Management touted extraordinary momentum.
But the persistent spending required to keep up with frontier models, combined with rapid workflow shifts, means investors are discounting the durability of these transitions. They don't believe the 40% margin will return in the second half.
Which brings us to the core debate. Is this company leveling up from a low-margin data vendor to a high-margin AI lifecycle partner? Or are they perpetually trapped in high-cost margin ramps just to maintain revenue.
Are they running faster on an increasingly expensive treadmill?
That is the question. So let's test these theories. It's time for our This Is Not Financial Advice segment. Imagine we are two rogue analysts pitching to a ruthless hedge fund committee. We need outrageous but plausible trade ideas based on this overreaction.
I'll go first. My pitch is built around volatility and guidance timing, the margin ramp reversion calendar spread.
Walk the committee through the execution.
The stock sold off on the timing of margin normalization, not top-line growth. They take the margin hit in early 2026, recovering to 40% plus by the second half. So this is a volatility crush play.
Break down the legs. What are we buying? What are we selling?
We sell near-term, slightly out-of-the-money call options expiring in Q1 or early Q2. The sell-off spiked implied volatility. We harvest that elevated premium.
Okay.
Simultaneously, we use that cash to buy longer-dated call options Q3 or Q4 expirations at a similar strike.
Let me play the skeptical portfolio manager. Explain the Greeks. What's our exposure to Vega?
Vega measures sensitivity to implied volatility. Right now, near-term Vega is inflated. By selling near-term calls, we are short Vega. We want volatility to crush down.
Which it usually does after earnings.
Exactly. You collect premium up front while the company wades through its margin trough. The stock likely chops sideways. The near-term calls expire worthless. You keep the cash.
In the back half of the year,
the high-margin synthetic data and agentic platforms kick in. Revenue diversification proves out. The narrative flips to margin expansion euphoria, the stock re-rates higher, and your long-dated Q4 calls explode in value.
it perfectly isolates the timing disconnect. The risk is if the stock craters 20% near term, but the $82 million cash cushion provides a floor. I like it.
What's your pitch?
I'm taking the other side. A fundamental pair trade based on the divergence in the AI data supply chain. The cognitive scaffolding pair trade.
Let's hear it.
Ruthless alpha generation. We go aggressively long on this specific company. We ride the 35% growth, the cash cushion, the Palantir catalyst, the 6.45% drone beat. To fund it, we aggressively short a basket of legacy data labeling companies and generic AI API wrappers.
Define the short leg. Why are API wrappers vulnerable?
They don't own a foundational model. They license OpenAI, wrap a UI around it, and sell it. When OpenAI updates their core model with that feature, the wrapper goes to zero overnight.
And the legacy labeling companies.
Dead technology. The era of humans blindly drawing boxes is over. The future is complex egocentric data and adversarial red teaming. This company's 31-point improvement in agent constraint satisfaction proves they have an engineering mode.
Meanwhile, the legacy vendors have no moat. They can't evaluate long context reasoning.
They will be zeroed out by synthetic data. This trade isolates the pure beta of the AI infrastructure market. We bet entirely on the shift from data quantity to data efficacy, long the cognitive scaffolding, short the human sweatshops and fragile wrappers.
A market-neutral bet on technological evolution. I love it.
So to recap the narrative today, a company executing 48% year-over-year growth, pivoting seamlessly through a $20 million deprecation, building cognitive scaffolding for autonomous agents, while the market myopically frets over a Q1 margin dip.
The disconnect is incredibly stark.
It truly is. Now, our strict disclaimers. Talk Tickers is for informational and entertainment purposes only. The preceding segment was absolutely not financial advice. Do your own rigorous due diligence. But before we sign off, leave us with a final, provocative thought to mull over. Something looking further over the horizon.
Consider the end game of world models and adversarial simulation pipelines. If this company is building systems that automatically generate targeted mitigation data sets, and their optimization pipelines use reinforcement learning to automatically close a 31-point gap,
Right.
how long until the software completely abstracts away the human in the loop?
We are watching the automation of the automators.
Exactly. If the goal is a perfectly self-improving synthetic data loop, does an elite AI data engineering company eventually code itself out of a job? Or, as the internet floods with synthetic garbage, do they become the sole gatekeepers of the only non-synthetic, human-verified ground truth data left in the world?
Does the data engineer engineer their own obsolescence or become the most indispensable entity in the global supply chain? That is a chilling and fascinating question. Thank you for joining us for this deep dive. If you want to understand the technology driving the tape, make sure you subscribe. We will be back soon with another intensive earnings breakdown.